Hello, welcome back. So now we're going to talk about the trading strategy that is very important in energy markets, and it falls under this broad name of spread trading. Okay, so what is a spread trade? It's a trade where you actually trade two different futures. Okay, you go long in one futures and you go short in the other futures, and your goal is to bet or to hedge a possible price convergence, so the spread narrowing, or a price divergence, the spread increasing. Okay, so you can do this on two different commodities, or you can do this trade on the same commodity, trading different months for the same commodity. The main advantage here is that when you do a spread trade, you don't have to guess the overall direction of the market. You just have to guess whether this spread is going to, again, increase or decrease. Okay, so let me illustrate how you do this. What is the trading rule with a figure? Okay, let me switch here to this one here. Okay, so suppose you have two assets. I'm calling here one asset that has a high price. These are all future prices. So suppose that we have an asset, let's call it H because it has a high price now, and we have another asset with a low price, which we'll call L. Okay, so this is the futures price for these two assets for delivery at some point later on in the future. Okay, so if you expect this spread that today is just this difference here to increase, okay, your strategy should be to go long on the asset that has a high price and to go short on the asset that has a low price. So suppose that you do that. So you buy H at this initial price and you sell L at this initial price. Okay, and then you have this position, and then time moves forward, and then at some point later on in the future, capital T, you close the position. And you were right, your expectation comes true, the spread really increases. And let's say that the futures price for H went up like this, okay? And the futures price for L went down like this. So you are going to make money on H, right? Because you are long on H, meaning you bought at H0, and now you sell at this higher HT, you make money on this contract. On this other contract, you also make money because you first sold it at L0, and later on, at this moment now, you close the position by buying it at L capital T. So you're buying at a low price, you sold it before at a high price, so again, you make money on this leg as well. So it's really good. You make money on both legs, okay? But the nice thing about this strategy is that even if it is not an evolution in such a nice way for you, you can still make money as long as the spread widens. So even in these other two cases that you see here, for example, this first case, where you still expected in the beginning the initial spread to widen, but then the evolution going forward, it's not exactly as good as in the first case. So the top asset, the high price, still went up, which is good. So you're still making money on this leg. But the second asset did not evolve in the best possible way. So this short leg is actually now making you lose money because you're short on this lower asset, right? So meaning that you first sell it here and then you buy it here. So you are losing money because you're buying at a high price and selling at a low price, which is a loss-making trade, right? But overall, since the spread at the end, this ST, is higher than the spread in the beginning, you still make money in the overall trade. When you add up the two legs, you still make money, and the amount of money you make is exactly the difference between the spread at the end and the spread in the beginning. Okay, so again, you just need to guess what is going to be the evolution of the spread. You don't need to guess the overall direction of the market, that the overall market is going up, or one is going up and the other going down, or even this third case where both of them are going down. So both the high asset and the low asset are decreasing in time, but you still make money as long as the spread increases. Okay, we're going to see an example in a second. On the other hand, if you expect a different scenario, if you expect the spread to narrow, so the prices to converge, you do exactly the opposite. So you short the one that has the high price, and you go long on the one that has the low price. In this case, it's very good because you make money on both legs, so on the short and the long, right? Here you're making money because you're first selling, then buying at a lower price. Down here you also make money because you're first buying at the low price and then selling at the high price, so very good. But even if the evolution is not exactly like that, so if the overall market goes up, as long as the spread narrows, you still make money. Or if the overall market goes down, as long as the spread narrows, you still make money. Okay? So let's look at the example we have here in the notes. This is still just a very simple example. So we are not using specific futures yet, let's just call it X and Y, right? We start at these two prices, 5 and 4. Okay? And let me again show this with a figure which is more, perhaps more intuitive. Oops, like this. Okay, so what we have here is that scenario that we were doing in the notes. The initial prices are 4 and 5, okay, for X and Y. And I expect the spread to do what? I expect the spread to widen. Okay, I expect the spread to widen. So if that is the case, I use the first rule here that says go long on the one that is more expensive, go short on the one that is less expensive. So that's exactly what I'm going to do here. I'm going to go long on X and I'm going to go short on Y. Okay, at these initial prices. Some time moves forward, and then 4 months later, I close the positions. Okay. So I look at the prices now. The X price is 6, the Y price is 4.5. Okay. So the spread, I guessed correctly. The spread went from 1 to 1.5. So what are my payoffs altogether? So I have a position in X that was long. So I first bought it at 5, then I sold it at 6. So that's the payoff from X. I was short in Y, meaning I first sold it at 4, meaning I got a positive 4. I later closed the position by buying it at the price here at the end, which is 4.5. So I buy it, I have a minus sign here. So this is the payoff from Y. Okay. I can also move these numbers around. So the final spread that you see here, this difference, is the difference between these two terminal values. So 6 comes from X, 4.5 comes from Y, right? So it's the spread at the end, as you see here. And the first two numbers gives me the spread at the beginning, at time 0. So the difference between 5 and 4, or 5 and 4 from here. Okay. So this is just to show you that the total payoff that I get is equal to the difference between the final and the initial spread. Okay, in this case 0.5. So I guessed correctly, the spread increased, even though I did not make money on both legs, because one went up, which is good, the other went up, which is bad, because I was short in this one, but still I make a profit equal to the difference between the final spread and the initial spread. Okay. All right, so now what we are going to do here is to show PDF here. What we're going to do now is to look at several different examples of this type of trades across all these different energy markets that we have been talking about before. Okay, so the first one is about these seasonal patterns in natural gas. Okay, all these examples here that we're going to look at have detailed solutions. Some points in the solution are open for you to fill the answers, but then if you read a little bit more, you will find that the answers are all implied somewhere later on. So you should be able to know whether you're answering correctly or not by just reading until the end of the exercise, and eventually you get all the answers somewhere in here. So I'm not going to go through all the details here in the video. I'm just going to highlight what each example is doing, and then if you have questions in class, we can go over the details. Okay. So again, this is a natural gas example. We are going to trade on these seasonal patterns that we have in natural gas. So in particular here, there's someone, a trader, that believes that in the winter, winters will become less cold, and therefore there will be less demand for natural gas, and so therefore he thinks that the prices will be, the winter peak will be smaller than what you see now in the curve. You can go back to the previous pages where we had this curve of natural gas futures, and you will see there a typical seasonal pattern. So what this trader is saying is that, well, the seasonal effect will be weaker. Okay, so how does he trade on that? So you look at the curve. You have a price here for winter, January, and you have a off-season price, April. Okay, so basically you expect this is the high price, this is the low price. You expect the spread to narrow, right? And according to the previous rule, what you should do is ... Let me know if you have questions in class. Okay, so you do the trades. Okay, and then let's say that some time later, when you close the position, these are the final prices. Okay, fill out this table here where you compute the profit for each of these positions. For your trade in the January contract, your trade in the April contract, and compute the payoff. This is how much you get. Okay, different trade. Now let's think about something you can do with the slope of the futures curve itself, right? So suppose for some reason, you can read up this scenario here. So suppose that for this reason you expect the curve to become even more inclined, steeper. Okay, so how can you trade on that, right? Think about this. We can talk about this in class. This is not just a one single solution answer. You can pick different points in the curve to trade. There are advantages and disadvantages of some points versus other points. So we can talk more about this in class once you think about it for a couple of minutes. Okay. A third example. So now we are talking about refined products, heating oil or diesel versus gasoline. So recall that these are the two main things that come out of a refinery. And what we're going to do now is to trade on the spread between these two outputs. Okay. So the two prices are obviously related because they are coming from the same production process, but the spread varies throughout the year for these reasons that you have described here. So this is specific to the market where we are. So in this example, this is about the US market, right? So people there in the summer drive a lot, and in the winter they need heating oil or diesel to warm up their houses, and that creates this pattern that is described here. Okay, typically in the summer, gasoline is more expensive than heating oil or diesel, and then relatively speaking, and then in the winter the relation is reversed. Okay, so example, so you have here prices for summer, prices for winter of both gasoline and heating oil, and now you have a couple of scenarios. So suppose you expect very nice summer weather and people will drive a lot more. Okay, so that will increase gasoline consumption. So what is your trading strategy? Again, it's applying that rule we have seen before. This is the high price. We're looking at the summer. This is the high price. This is the low price. I am saying that this, in my scenario, I'm saying that this will be even higher. So I'm expecting the spread to widen. Okay, so use the rule that we discussed before for that case. Go long on the first, go short on the low price. Second scenario, suppose now you think that the winter will not be as cold as the market expects, so people will not use as much heating oil as usual, which means that this price for heating oil in the winter will be closer to gasoline. Okay, instead of being so high, it will be a bit lower. Okay, again, think of what is your trading strategy. Okay, so now this is the high price, that is the low price. You expect the spread to narrow. You should trade according to a narrowing expectation. Okay. So here you have some scenario for when you close these positions and compute the check that you can get this profit. Okay. So actually this part here is just for the second strategy. Again, make sure you get these prices, right? Okay, so now let's talk about trading strategies for the spreads that we have defined before. We talked in the previous chapters. We talked about different spreads. In this one here, the crack spread. Recall, it's the spread for cracking an oil molecule, meaning refining an oil molecule. So it's basically the difference between the price of the output of a refinery and the price of the input. Okay. So example, suppose we have a refinery that uses oil in this 3-to-1 ratio, meaning uses 3 barrels of oil to get 2 barrels of gasoline and 1 barrel of heating oil or diesel. And this takes about a month, and now we want to hedge the production for some point in the future. Okay, these are the prices for that point in the future: oil, and then gasoline and heating oil. Okay, so now what we want to do is we want to compute the crack spread. Okay, using that definition we have seen before, and then determine the hedging strategy. All right. Given that this is the total amount of production we expect to have over that month. Okay, so doing the same type of calculations we have done in previous chapters for the crack spread, but now instead of using spot prices, what we're using are these future prices, but we do exactly the same type of calculations we did before, and make sure that you are able to get at this crack spread. Okay, so this is the profit the refinery gets for each barrel of oil that it refines. Okay, so now the new part is how we do the hedging strategy. Okay, so first you need to determine the quantities, which I mean, it's just to divide by the number of barrels you get by the contract size. The contract specifications are the ones that we have in the previous sections for these two contracts, these three contracts here. Okay, so each contract is for 1,000 barrels essentially. So you basically just divide this quantity by 1,000, you get the number of contracts, and likewise for gasoline and heating oil. So now just the question is whether you go long or short in these contracts. Okay, so there are two ways of thinking about that. The easiest way, the more direct way, is that you want to fix the price of your inputs, right? So you want to buy the contract, you want to buy oil, so you go long on oil, and you want to fix the price at which you sell your outputs, so you go short on gasoline and short on heating oil. Okay, that's the first more direct way. The second more indirect way, and to connect this to this spread trading rule that we have seen, is the following: the refinery is so the refinery sells the refined outputs and buys the oil, right? So the refinery will lose money if the difference between the output and the input decreases. Okay, so which means that what? It means that the hedging strategy must pay off in that case. Okay, so that's a good principle. In a good way to think about hedging strategies, that the hedging strategy must always compensate your underlying exposure. So basically you want to set up a hedging strategy that makes money if the spread narrows, right? And as we have seen before, a hedging strategy that pays off when the spread narrows is to short the high price assets, in this case gasoline and heating oil, and to buy the low price asset, in this case the input, the crude oil, which is obviously less expensive than the output. Okay, so through either one of these two alternative approaches, you conclude that you get to the same hedging strategy: buy oil, sell gasoline, and sell heating oil. Okay. And then once you have that, you can compute the gross profit locked in just by scaling up the spread that you have fixed already. Okay. All right. Another spread, a spark spread. This is the spread for a gas-fired power generator. Again, we have seen the definition before. It's again the same idea: price of output minus price of input. Okay. Again, the example here, we have a plant. We have all the details here about how much electricity we are going to generate. We have to compute how much gas we are going to need to generate that electricity. Again, those are the same type of calculations we have done before for a natural gas generator. Now we have the prices here for the future prices, and exactly the same type of calculation as we have done before. So compute the spark spread. Again, now we are using future prices instead of spot prices, but it's the same formula we had before. Okay. So here this spark spread is just what? It's just the difference between the output price, which would be the electricity price, minus the cost of generating 1 unit of electricity. The cost of generating 1 unit of electricity will be depends on the efficiency or the heat rate of the plant, which is 10 times the price of gas, which is 4.187. So this times 10 gives me 41.87, and therefore 41.87. The difference between 47.13 and 41.87 is this spark spread that we see here, 5.26. Okay. So what is the hedging strategy? Again, think about what you should do here for a second. It's again two ways to get there: either a very straightforward intuition where you need to fix the input price, so you need to buy natural gas, and you need to fix the output price, so you need to sell electricity futures. Okay, or this alternative indirect intuition, which links this to spread trading. Okay, and then make sure you get this. You're able to do these calculations of determining the quantity of electricity futures, natural gas futures, and the total profit that you lock in. Okay, one more example. The dark spread, which we have seen before, and now dark because it's for coal. It's the spread for a coal-fired power generation, and it's the same idea: price of the output, which is electricity, minus the price of input, which is the amount of coal I need to generate 1 unit of electricity. Right. So here is the scenario. Now we're going to use these futures on coal. Recall this futures here on coal is defined in the previous section when we talk about coal futures. It's this one here. So that's where these properties of the contract, these characteristics of the contract come from. And then the same type of strategy as in the previous examples. Okay, so exactly the same logic, the same intuition. Go through these calculations. Compute first the dark spread using the formulas we have seen before. Define the hedging strategy, and make sure you get the number of contracts you need to trade, and the spread. The gross profit that comes out of all these calculations. Okay, so basically the amount of profit that we are able to lock in if we do this trading strategy. All right. Again, we'll go through the details in class. If you have any questions, please try to fill all these blanks here and make sure you get all the numbers that you see in these examples. Let me know in class if you have any questions. All right, that's it.